Hello, everyone. David here from Advantage Accounting Group. If you own an S corporation, there's one simple year-end move that you could do to save thousands of dollars in taxes, and it takes less than 15 minutes. It's what I call an S-Corp salary tune-up. And in this video, I'll walk you through what it is, why it matters, how to do it, and how much it can save you. So let's get to work. So here's the big idea. If you're an S-Corp owner, you probably know you have to pay yourself a reasonable salary. But here's what most people miss. Your salary shouldn't be set and forgotten. It should be reviewed every year throughout the year because your profits change, your workload changes, and the IRS looks at reasonable compensation differently when those numbers move. When you pay yourself too much, you overpaid payroll taxes. When you pay yourself too little, the IRS could question whether you're avoiding payroll taxes. So finding the right balance, that's where the savings are. So say your business made $15,000 in profit. You pay yourself $90,000 as salary. That leaves $60,000 as distributions, which aren't subject to payroll tax. Now imagine we discover that a more reasonable salary for the work that you've done would be $60,000, not $90,000. That's a $30,000 difference that could save you roughly $4,000 in payroll tax for the year. Same income, same business, just smarter planning. Now, on the other hand, if you paid yourself only $20,000 on $150,000 in profit, that's when the IRS might say, hey, wait a second, that doesn't look right because that salary isn't reasonable for what you do. So there's a sweet spot, not too high, not too low, and that's what the tune-up of the salary finds. So how do we do this? Well, here's how I do it for my clients each fall and all actually throughout the whole year. First, we pull year-to-date profit from your books, QuickBooks or your accounting software. Second, we look at your role in the business. Are you the one doing the core work every day, or do you have a team handling most of the work that while you manage it? Third, we apply what I call the payroll metrics. And what this is basically a ratio of salary to distribution that adjusts based on your net income. So, for example, if your net income is under $75,000, your salary might be around 50% of that. Around $100,000, maybe 45%. And as profit rises, that ratio can decrease, but usually not below, say, something like 20%. It's simple, it's defensible, and it keeps you compliant with the IRS guidelines while maximizing your tax savings. If you'd like me to walk you through this matrix using your own numbers, I'll share a link at the end where you can schedule a quick call and we can go through it. So why does this matter before year end? Well, the reason timing matters is because you can't fix this after the year closes. Your salary has to be paid before the end of the year. So if you discover in January that you should have paid yourself differently, it's too late to change that. That's why I encourage every S-Corp owner to do this review in October, November, or sometime in early December. It's one of the fastest, easiest, and most legal ways to reduce your taxes before the end of the year. If you want to check your own numbers, I actually created a free tax savings checklist for small business owners. It walks you through the salary tune-up and 4 other quick year-end tax strategies that can save you thousands. You can download it using the link below. And if you'd like my help reviewing your salary, there's also a link to book a short S-Corp salary tune-up call. It's about 15 minutes, and I'll show you what your ideal salary range could be before the end of December. If you found this helpful, please click on the like, subscribe, and share it with another business owner who wants to keep more of what they earn as well. I post practical and plain English tips every month. No jargon, no just real strategies that help small business owners save money and stay compliant. Thanks for watching, and I'll catch you on the next one.